David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Seth Edgell are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, President of Keystone Financial Group here in Trussville, to discuss the challenges of investment management during times of heightened sentiment. David, thanks so much for being with us today. You've spoken often about how you're primarily focused on things that can be quantified and the importance of rules-based and data-driven investment management techniques. But today, you're here to discuss the impact of sentiment and states of mind and how that must be appropriately managed when helping clients reach their planning goals.
That's correct. Sentiment is real. It has a discernible impact on asset valuation, and we must be observant of that as we are navigating through challenging periods of time. I have encouraged my clients to remember that this is a marathon, not a sprint. In my opinion, this will likely not be one of those V-shaped patterns of economic recovery. Because of this, it is increasingly imperative to find intestinal fortitude and to have patience as we attempt to separate fact from fiction and navigate through palpable sentiment. Now, off the cuff, one observation that I can offer as it pertains to sentiment is that it will eventually dissipate. It will only dissipate, however, with time. So keep in mind that the magnitude of the event behind the sentiment is also important. Think of it this way. If you throw a small pebble in the water, it will form small rings that will dissipate quickly. However, if you throw a large boulder in the water, those waves will be larger and require more time to dissipate. We've experienced several pandemic-related boulders over the last 3 years, so expecting the resulting negative sentiment waves to dissipate quickly in a V-shaped manner is just not reasonable. We've talked in the past about the unusual characteristics of this post-crisis period of time. We've talked about the difficulty that comes with relying on anecdotal evidence when it is 90 years old. In many ways, this is the most challenging time of my 33-year career, but it is at times such as these when it is necessary to be dispassionate and with a thick skin, attempt to find the quantifiable singularity hidden behind the fog of sentiment. If it exists, then we take steps to avoid it. If it doesn't exist, then you must attempt to make market-based dislocations of value work in your favor. Today, I want to discuss what I perceive to be the top areas of angst that have served to fixate market attention and attempt to leave your viewers with a perspective that may be of benefit at this time. As we are discussing these, I would also like to offer my thoughts on the consumption of information and how this can serve to amplify the impact of negative sentiment. Lastly, I will offer some thoughts on strategic action that can be taken to insulate your portfolio from the impact of overly negative sentiment.
Well, David, I'm looking forward to hearing your thoughts on these areas. Why don't we start with what you perceive to be the major areas of concern? Where do you believe negative sentiment is most highly concentrated? And can you share any thoughts on the origin of that sentiment?
Absolutely. Let's start with an observation about inflation. By the data, inflation has indeed abated sharply. In 14 of the previous 16 months, the Consumer Price Index, the Producer Price Index, and the PCE deflator have all declined. Indeed, the most recent data suggests that on average, wages rose by a faster rate than did inflation. That is a quantifiable, factual, and fantastic sign. Unfortunately, if I were to ask the average person on the street if they believed that inflation was cooling, they would probably look at me as though I had a third eye. The truth is that inflation is indeed getting better. The perception, however, is that we remain under significant economic stress. This is a function of time. It's the duration of the event, not where we are in the cycle. Nearly 2 years ago, the opposite was true. Inflation was significantly higher than the rate by which our incomes were increasing. In my opinion, people largely still feel poor, and this has impacted consumer sentiment. If you don't have an optimistic outlook as a consumer, then generally patterns of consumption will reflect that negativity. It has just gone on for so long. There is a negative feedback loop at work here. For nearly 2 years, our ability to consume has gone backwards. Recent research shows that nearly 2/3 of American households remain living paycheck to paycheck. According to the Federal Reserve, nominal credit card debt is at an all-time high. Due to the removal of accommodation, bond yields have risen sharply, taking interest rates with them. According to Dave Haviland, average credit card interest rates are at a multi-decade high. If gross domestic product is 70% consumption and our ability to consume has declined over the last 2 years, while we are amassing a record amount of credit card debt that is now very expensive to service, then one data point is not going to reverse a trend and create a positive feedback loop. It will take time. We need to have an extended period of time where inflation is muted, wages are increasing, our ability to consume is consistently expanding before we can expect attitudes toward consumption to change and therefore patterns of consumption to change. Metaphorically, in my opinion, this is going to be akin to watching grass grow. It will be slow and arduous. Again, this will likely be an economic marathon requiring much patience as we endure the sentiment that remains following an extended period of inflation-induced stress on the consumer.
Well, inflation is clearly something that has impacted everyone, and this explanation helps to clarify the negative sentiment that we still have today. David, can you elaborate on other areas of concern that, in your opinion, are having a negative impact on sentiment?
Yeah, we would be here all day if I elaborated fully on these, so let me offer a shorter list of these concern areas. First, there's a concern that the Federal Reserve will revert to an overly draconian stance as it continues to remove accommodation. Indeed, in my opinion, the truth is that the Federal Reserve has not deviated from their approach since March of last year. Did the Fed shock the markets? Yes. And as we've discussed in the past, I believe that market participants conflated the removal of accommodation with the fighting of inflation. And indeed, these two are discernible and mutually exclusive objectives. Between the Federal Reserve and the expectations of the market participants, I believe that the Federal Reserve has been consistent, while the market continues to incorrectly outguess the Federal Reserve. In my opinion, fear over an overly restrictive Fed is not grounded in a factual observation. We have talked throughout the year about the potential for a recession. Indeed, I am hearing opinions in the media and from economists that another 2008-style recession may be on our doorstep. However, I'm also hearing a basket of other economists describing this in terms of being a rolling recession. Well, at heart, I'm an optimist. A rolling recession implies that you are also in a rolling recovery. It is the word rolling, however, that jumps off the page, in my opinion. We've seen double-dip recessions, but never a rolling recession. That implies long-term. For well over a year, I have suggested that I thought we would find ourselves in such an economic event. Again, this being a marathon, it will take time for the event negative feedback loop to reverse course. That's not going to happen overnight. Therefore, in my opinion, I believe that what we are seeing now and what we will likely see over the next few years is an economy that struggles to find traction. Market participants, however, believe, in my opinion, that a long and deep recession remains in our future. To this point, anyway, I fail to see any quantifiable evidence behind that fear. Earlier in the year, there was a concern that the United States would default on its debt. In the history of the United States, that has never happened, but that did not stop the market from worrying about it over the summer as budget negotiations in Washington stalled. Currently, we're hearing about the United Auto Workers strike and how that could serve to exacerbate an anticipated deep and long recession. The war between Russia and Ukraine continues to amplify geopolitical concerns. We have an election cycle on the horizon. The market is replete with shiny objects that are captivating the attention of market participants. The more fixated attention becomes on these areas, the more short-sighted market participants can become. In an environment like this, overly negative sentiment can run rampantly. I believe this is where we are. And now the larger question is, how do we manage the sentiment while we are pursuing planning objectives?
Well, that's a great segue into my next question. How do you advise your clients during periods of times such as these to minimize the impact of sentiment and keep them on track for the attainment of long-term goals?
One routinely piece of advice that I've given is to be mindful of your exposure to information. And today we are bombarded with information from our mobile phones, from our computers, the television, the internet. This can serve as a breeding ground for misinformation and disinformation, and sometimes it can be easy to accept such at face value without digging below the surface to verify the validity of articles and opinions. I encourage my clients to give a very wide berth to sensationalism. Avoid it. Behind my side of the desk, I spend much time following a rules-based approach, following dispassionate and quantifiable data. In my opinion, this data does not seem to justify much of the negative sentiment that seems to be hanging over the market, and therefore I believe that there are many opportunities for those with the intestinal fortitude to remain vigilant. In previous videos, we've referred to these as being coiled springs. As negative sentiment and market angst serve to crimp a spring into a tight coil, potential energy grows. Now that energy will not be released, however, and converted into kinetic energy until a catalyst is present. Now, what might that catalyst be? Could it be an unexpectedly positive remark from an analyst? Could it be a significantly better quarterly report with regard to earnings and revenue? The paradox of a coiled spring is that you must be sitting on it before it pops if it is to be of any benefit in your portfolio. You've heard this before, and it is not a cliche. Be greedy when others are fearful. In my opinion, there is a lot of fear in the markets right now. That, in my opinion, cannot be validated with quantifiable data. At times such as these, again, for those with intestinal fortitude and a thick skin, it would be of benefit to remain dispassionate and let the data be your guide. Much like a pilot relies on instrumentation when visibility is opaque, if we're going to fly through this fog of negative sentiment, we must rely on that which we can quantify.
David, that sounds like great advice. Do you have any high-level closing thoughts for our viewers as we consider the fourth quarter and the election year ahead?
Yeah, again, remember, this is a marathon. This will not be over tomorrow, and patience is worth its weight in platinum. I would suggest that everyone take several steps back from the trees and observe the forest. Remain focused on the objectives that you have codified in your long-term planning. At the end of the day, what happens in the market in the short term is not as important as making progress toward the achievement of the goals themselves. Yeah, we have endured some unusually difficult post-pandemic years. But since the inception of your plan, on average per year, are you still ahead of the targets outlined within that plan? If so, then you're still on pace to achieve these goals. Day-to-day exposure to risk should be tactical and driven by a rules-based, economically data-driven approach. Long-term, however, we can lose sight of the objectives that we were trying to achieve if we are focused on the latest sensationalism of the day. Take a step back, evaluate where you are, and breathe.
Well, David, as always, thank you for this information. And for additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brandon Dawkins.
David Guttery and Seth Edgell independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.